a moment. Just for clarity and information purposes, the first two rows have been reserved for other senators, members of the Finance Committee, and also there's some seats behind us if others need to space out. For those that are in the audience, I would encourage you to please space out some, try to get 6 feet apart as we conduct this meeting. We'll start in a couple of minutes. Thanks. (10:30), and I'm going to call the Appropriations Committee meeting to order. Again, if you would, make sure you try to space out as best as possible. Should be chairs in the first couple of rows for any senators on the Finance Committee that that are sitting in. And before we call on our two speakers today, which are our state economist Darren Webb and Herb Frierson, our Revenue Commissioner, I did want to announce the Appropriation Subcommittee Chairman meeting times this afternoon. We will meet in my office, and I've spaced it out so we'll have 4 at a time, so we'll have plenty of room to space out. But at 2 o'clock, it'll be Senators DeBar, Branning, Frazier, and Wiggins. At 2:15, Johnson, Michelle, Gary Jackson, and Blackwell. At 2:30, Senators Hill, Moran, Delano, and Butler. And at 2:45, Senators Robert Jackson, Turner Ford, Sampson Jackson, and Polk. I will see each of you at those times. If you have a problem, I know there's a 2:30 Wildlife and Fisheries meeting. If you happen to be conflicted with that meeting, let me know after we finish here today, and we'll reschedule you to one of the other times, and we'll shift things around a little bit. With that said, I was looking for the Revenue Commissioner, Herb Frierson. I might let him go first, but since, well, Darren, if you don't mind, I may let you go last to talk, since I think the way I would like to look at this is the revenue commissioner could talk to us a little bit about a revenue update and more of the immediate situation, and then the economic outlook, of course, is immediate, but also more long distance too, and long-term looking. I'm told he is on the way. All right. While we're getting ready for Mr. Frierson to come forward, if you're too crowded, if you don't feel comfortable, if you're not spaced well enough, this is webcast, and you're more than welcome to go to another office in the Capitol and tune in to watch this briefing. So feel free to spread out. Please spread out and make sure we're practicing safe social distancing. With that being said, I'll call on our Revenue Commissioner, Herbert Frierson, to give us a presentation.
It's kind of hard talking through that. Is that all right with y'all?
That's fine with me.
Okay. Thank you, Mr. Chairman, ladies and gentlemen of the Senate. Appreciate you letting us be here today. I think that had we collected income tax in April, we'd be considerably over the estimate right now as we speak. We're doing a little better than we thought we were going to be doing at this time a month ago. In fact, if you counted the income tax and extension payments in 20, you'd be about 135 million up. If you count, if you don't count them in 20, well, then you're going to be down some. It's just that's a decision y'all going to have to make as legislators, how you count that money, if you're going to count it in 20 or you're going to count it in 21. And so any estimate on how we finish 20 is based on what you're going to do with that money that comes in on the 15th. I've heard a scenario said that, well, you can just go ahead and count it based on what DOR's estimate of it would be. So how much do you think that we would collect on July the 15th? I give you a variance because right now we're too far out to try and nail that number down. We collected $35 million in corporate extension payments that we did not anticipate to collect in the month of May already. So, it's hard to nail that number down this far out. When we get a little further closer to July, we'll be able to do it. But you could be anywhere from about 335 to about 365 is what you would probably collect on the 15th, somewhere in there. The low end would be contributing about a 5% delinquency, and that's based on the past history from the last recession. That we believe, because we believe there's a lot of people had the money on April 15th and could have made the payments, but they broke now. So they're going to be negotiating a settlement with a payment plan or they're not even going to be in business at all, one or the other. So that's kind of sad, but that's where we're at. As of Friday, May the 22nd, 2020, we are 44.9 million under the sign and die estimate. Remember, the sign and die estimate was made last April. We revised that up in October, and we'll talk about that some more in a minute. The sales tax is 16 million or 9% under the month of May, for the month of May. The general fund transfers are 23 million, okay? Let me touch on something before I go any further. DOR, we collect total cash. Then out of total cash, we transfer to the general fund. So you have a general fund diversion out of there. And we'll talk about that a little more, but that was confusing to me as a legislator a lot of times. One person be talking on the cash sheet and the other person talking on the general fund. I'm going to make reference to the cash sheet because I want you to see how much is diverted from the cash sheet, that is not diverted. How much it doesn't go to the general fund is what I want you to see. There's a substantial amount of money there every year. Okay, sales tax, our cash-to-cash collection was 13 million higher than this time last year. okay? Use tax collections exceeded the estimate by $2 million for the month of May. The general fund transfers are $4 million above the prior year. Would have been a lot more, but you diverted use tax in the from the general fund to the cities and the counties, out from the cash sheet to the cities and the counties for the streets and bridges. Individual income tax is under estimate for the month by $51.6 million or 28%. This is due to the change in the due date. The withholding collections are reported in the income tax amounts, but they are about $30 million for the month of May. As of Friday, we have reached over 1 million returns. That's about 82% of the filers based on who filed last year and filed this year. We thought it was a little higher, but we went back and looked, and it's just 82%. Our payments, our payment returns, estimated payments and extension payments actually exceeded last May by $3.8 million. The only factors affecting income tax collection at this point in time is a delayed date. So we think income tax is still going to come in pretty strong, probably a little bit below where we thought it was going to be because of the delinquency, because of just some people just won't be able to afford to make that payment. Corporate income tax exceeds the estimate in May by $14 million. That's because they paid their extension payments on the next quarter. We collected $39 million in estimated payments this month that we did not expect. Have we passed out this sheet right here to the committee? The committee does have this one. If you'll look at this one, if you'll lay another sheet over it and look at it horizontally, line by line, you'll see that pretty much I just read a narrative of what this page is. So I think you're going to potentially make the estimate if you count the income and extension payments collected in 20. If you don't count them in 20, you're going to be considerably under the estimate. It's a shell game either way you go, because the growth that you have in 20, more than likely, and Darren can speak much better to this than I can, but more than likely that won't be sustained. So you're going to have, you might be dealing with one-time money either way you go. In other words, your growth may be one-time money next year, the growth this year, if it shrinks that much, if next year's collections shrink that much. So if you wouldn't put a large amount of this growth in 20 and reoccurring expenses, I'm saying you might have difficulty sustaining that in the next fiscal year. The bottom line is that it's not as bad as I thought it was going to be a month ago, Mr. Chairman. I was pretty concerned about it at that point in time, and I hope what I've read to you and given to you makes sense. If it hadn't, I'll try to clarify it for you.
Thank you, Herb. Let's do this. Let's hear from Darren first.
Okay.
If you can hang around, and we'll take questions from the
All right,
members
thank you.
after that. Thank you, Herb.
Good afternoon, or good morning, I guess. It's still morning, so seems like it's afternoon. I'm going to talk a little bit about the economy. I'll talk about the national economy, the state economy, and then I'll give some of my perspectives on the revenues. I will mention this, that we released an economic outlook in April, sort of the end of April. That's available on a PDF file, and it's you can shoot myself or email Jana an email, and we can send that to you. Since that time, there's been a new forecast, new national forecast. Normally, we don't update on a monthly basis. On the state level, we update on a quarterly basis. But I'm probably going to release another revised estimate for the economy probably next week. What I'm sharing with you today would reflect that update. I've already gone through, at least on the headline numbers, and looked at some of these things. So it's going to reflect that. Basically, the story remains the same. As a general rule, the recession is expected to be deeper than what we were saying in April, and the recovery time, because the recession is deeper, it takes longer for us to fully recover. So a lot of people will describe the current situation. You hear all these phrases all the time. It's unprecedented. It's uncharted waters, and those are apt descriptions. This is totally new. This is something that we've never experienced. Certainly we've had pandemics before. I don't think we've ever had the kind of global response to a pandemic like we have this time. And what I'm specifically referring to is the essentially shutting down of the global economy. And if going into this episode, the national economy and somewhat to a lesser extent, the state's economy was doing quite well. And so this is like slamming on the brakes for the economy, all right? So I could show you a lot of different slides. I'm trying to be brief, and so I'm just going to show you just a few. This is consumer and business confidence. The consumer confidence is on the left-hand side, and the business confidence is on the right. And what I've done is I've put this is just basically the past couple of years worth of data, and that orange line, I think it's orange, is just where the low point was during the last recession. And so you can see that while consumer confidence has plummeted, as well as business confidence, we're not to the level that we had fallen in the previous recession, the Great Recession. Now, the difference is that we have experienced the decline much more rapidly. We basically have done it in a month. Okay, the consumer sentiment just collapsed, and likewise business confidence has also collapsed. And you start thinking about, well, why this was. We basically shut down everything. Air travel went to 100% below a year ago. Hotel activity went to 80% below a year ago. Dine-in restaurants 100% below a year ago. Movie receipts down 100% from a year ago. Schools and colleges shifted to online, which that affected their economies in the local areas. Eventually, many businesses, if not most businesses, were closed across the country. Consumer spending then just fell off the cliff. We had wealth effects. We had employment effects. Auto sales, for example, is expected to hit a low in this quarter of 9.9 million annual equivalent. So to give you some perspective, we were running somewhere around 16.8 million. All right, so now we're down to 9.9 million, and probably, looking going forward at the recession and coming out of the recession, we're probably not going to be back to 17 million for quite some time. In fact, I think it's 2021. Our projections are for around 12.9 million. So just a small uptick in that. So again, just unprecedented decline. How much of a decline? This is real GDP, and this is annualized quarterly growth rates. Now, I want to define that because it kind of gets confusing for people. But an annualized, a quarterly growth rate would be the growth from the previous quarter. An annualized quarterly growth rate is that multiplied times 4. You say, well, why do you do that? Well, what that does is it allows us to compare it to a typical year. And so it's basically making the assumption that if you continue at this rate of decline for a full 4 quarters, this is what kind of annual decline that you would have. So again, the economy was, we slammed on brakes. We saw tremendous decline. We have plummeted ourselves into a recession, and the effect is quite staggering. BEA, that's the group of people who actually comes up with the GDP numbers. They estimate GDP. And they say that we declined in the first quarter 4.8%. So the reason why we declined in the first quarter was primarily because we hit the brakes in March as a nation. And so we saw the decline there. That is a first estimate. I want to make that clear. It's a first estimate. They're basing it on preliminary numbers that will be revised, and that number will change. I don't know, to what degree it'll change, whether it'll go up or go down, but it is going to change. It's a preliminary number. So then the economy then nosedived going into the second quarter, as we had the shelter-in-place orders going across the country. Now, we've got an estimate for the number. We think it's about 36.5% decline, again, on an annualized basis. That's actually worse than what we said back in April. In April, it was 29%, so now 36.5%. Now, we are starting to see some of the economy begin to open up. We think that becomes a little bit more in earnest as we go into the third quarter, and that means you start to see some growth, and actually fairly robust growth, 6.1% on an annualized basis is quite strong, and then it gains momentum as we go into the early parts of 2021. And then, starts to decline a little bit, the growth rates do, and you get to somewhat more normal by the time you get into 2022. So, this reflects the CARES Act. The CARES Act was not a stimulus bill. It was designed, I think, to kind of protect the economic infrastructure so that as the economy did begin, there was an economy to grow. That said, there were checks sent out that did give income support. There is significant unemployment benefits associated with that, and for a state like Mississippi, that's kind of a big deal. It's a lot of money for us. There is a possibility of another stimulus. I'm not sure how that all plays out. I can't predict what politicians do, but nevertheless, there is a talk of that, and what that includes, again, we have no idea. So there's no second stimulus included in this forecast. So if you look at it on a level basis, and this is before was the growth rates, this is the levels, you can see this is where we were in 2019 fourth quarter. We see the decline, we hit bottom in the second quarter, and then we see a sort of a gradual increase. We are expecting some lingering impacts of the recession even as the economy begins to go. That is, it affects the way people buy, it affects whether or not they go into social places where there's lots of crowds. We think there's going to be a lingering effect associated with that. But nevertheless, if you look at from the peak to the trough, so 2019 fourth quarter to second quarter of 2020, that's an 11.8% decline. That is almost triple the decline that we experienced in the Great Recession. There was 3.9% then. So that's a very steep decline, and I'm going to show you a slide in a minute to show you just how steep. But nevertheless, because it is so deep, it's going to take some time for us to get back to our pre-recession level. And this says sometime mid-2022 before we get back to the pre-recession level. So this is a graph. It's a little nerdy, but it's a good graph if you can follow what it says. What it does is it tries to compare this recession to what's called the Great Recession, the 2008 recession. And what I've done is I have indexed both series of GDP to their pre-recession peak. Okay, so 100% is the pre-recession peak. For 2008, that would have been the second quarter of 2008. For this one, it would have been the fourth quarter of 2019. And then I've looked at where our projections are for this recession versus the last recession. And so as you can see, this recession is extremely deeper than the last recession. The last recession was a far more gradual decline. This is just falling off the cliff basically in one quarter. But on the other hand, the current recession is relatively short. That is, we begin to grow rapidly. We begin to grow by the third quarter. So technically, it didn't last very long. But because it is so deep, it still takes us almost as many quarters to get back to where we were as it did in 2008. Again, because of the depth of the recession. So some people say, well, why isn't it more immediate? Why don't you just flip the switch and we get back to going again? Again, very deep recession, extremely widespread. Just about every industry is affected. Just about every region is affected. The recession itself will affect supply chains. That's going to have problems going forward. A lot of what we have lost can never be regained. That is, we've just now been able to get our haircuts. We didn't go get 2 haircuts. If you went and had your oil change, you didn't get your oil change twice. You only did it one time. So there's a loss, particularly in the service sector, that will never be regained. I think, as I mentioned already, attitudes will change, and there could be lingering effects associated with that. One of the things that IHS Markit, that's a national forecasting agency that we subscribe to, one of the things that they keep pointing out is that after 9/11, it took 2.5 years for air travel to get back to normal, okay? So people were fearful of travel, fearful of being in an airplane because they thought there could be a terrorist. Well, it's quite likely that they could have the same type of fear with regard to this virus, and perhaps even more so. But nevertheless, We do think it will affect whether or not people go to places where there's large crowds. It's a global recession, so there's no country out there that's going to prop everybody else up or pull everybody else up. So again, deep recession, recovery begins rapidly, or quickly I should say, but it still takes us a long time to get out of the recession. So this is just annual growth rates all the way back to 1931. And so this recession annually for 2020 is a decline of 7.3%, far deeper than what we saw in 2009. And actually, you'd have to go all the way back to right after World War II to see anything like that. And actually, you know, World War II was the decline then was much greater. People ask about the Great Depression. Are we in a depression? It's not like the Great Depression. The Great Depression, we had a 12.9% decline, and also it lasted for multiple years. We're not anticipating this being that long. We do expect growth by 2021 to be expect us to be growing about 5.1% for calendar year 21, 4.6% for 2022, and 3.9% for 2023. So again, deep recession, recovery begins. It does take a while to get over. This is monthly change in employment. In March, employment fell 881,000 jobs. We thought that was incredible. That was basically every job that we'd gained since November, okay? Well, then we got the May number, or excuse me, the April number, and it was 20 million. I couldn't put it on the chart because it would make everything else just look ridiculous. You wouldn't even be able to tell anything, so I didn't even put it on there. So 20 million. Nothing like that ever before. That's basically every job we've gained over the past decade, okay? So tremendous decline in jobs. And we also think that the jobs recovery will lag that of the GDP recovery. And that was the case in 2008 and also the case in 2001. Basically, the economy has to kind of get going before people begin to hire. And so businesses tend to have a wait-and-see attitude. As the economy begins to grow, they say, well, maybe I can hire a few more people back, but they're very careful in doing that. So, you know, we may see, and probably will see, a little bit of a bounce in terms of jobs once, you know, the recovery begins. But then, as the realities and the fundamentals of the economy sort of take hold, we could see further declines in employment. So maybe initially we rehire restaurant workers, for example, but then as you get going just a little bit, manufacturing takes a hit. So we kind of expect something along those lines. In terms of percent change in non-farm employment, down 55% for the second quarter. Tremendous decline. We actually think we're going to see a decline in the third quarter as well of 9.8% before we start to see some growth in the fourth quarter. That means unemployment reaches a peak of almost 20% by the third quarter. Again, that's the fourth quarter, excuse me, that's the third quarter. So, you know, tremendous unemployment. We've heard a lot of stories about that, initial claims and that sort of thing. The oil sector has been hit especially hard. Basically, even before the recession, or at least before the COVID shutdown, there was a trade war between Russia and Saudi Arabia that was producing a glut of oil and reducing prices. So now we're in a situation where we have low demand, we have low prices, and we have dwindling storage capacity. So we basically have no place to put it. What that means is less investment in oil wells and equipment, and that affects the overall economy. So we can kind of see how the energy sector, whereas the consumer sector is affecting us now, as we go forward, the energy sector begins to affect us more, as well as some other commodity pricing, commodity markets also. But nevertheless, you know, the global recession, we think, will result in low prices for some time. We think it's actually going to be 2022 before we get back to the $40 to $50 a barrel level. Now, I want to throw this in here because, you know, it's relevant for Mississippi. Mississippi, technically speaking, if you look at the GDP numbers or even if you look at the employment numbers, we don't have a lot of people in that industry. But what we have found watching this over the years is that when we have these plummeting prices, it does affect Mississippi, and that's because many of our people work in other states. So the data shows that they don't really work in Mississippi. They don't, but they do bring their paychecks home, and they spend them, and so they are taking a big hit with all this. Anecdotal evidence tells us that a lot of people have been laid off. A lot of people have taken pay cuts. So this does affect us, and the oil prices are relevant for us. So what does this mean for the overall Mississippi economy? Again, the story is basically the same. Deep recession, long recovery. Historically speaking, we do not do as well as the U.S. It's very rarely that we outperform the U.S. We think that for the first quarter, we declined about 5.3%. We think for the second quarter, we are going to decline 44%. So, like the nation, we do think that recovery begins in the third quarter and then strengthens in the fourth quarter. So basically, we're following the same pattern as the nation, but at lower growth rates. If you think about the last recession, one of the things that really drove growth during the recovery was growth in metro areas. Mississippi does not have metro areas. We have relatively small metro areas, and so we did not participate in that early recovery. And that could be the case this time as well. We still expect fairly robust growth rates, but again, lower than the nation as a whole. And we think that we'll probably get back to more normal growth rates sometime in 2022. So this means that it does take us longer to get back to our pre-recession level, whereas at the nation, we think sometime mid-2022. I only carried my model out to the end of 2022. I didn't carry it out any further because, honestly, I'm just not so sure that there's much we can say about that, especially at the state level. But at the earliest, we're looking at 2023 before we're back to our pre-recession levels. Some say, well, you're pessimistic. Maybe I am, but if you go back to the last recession, as of the fourth quarter of 2019, we had technically not regained the pre-recession back in 2008 level, okay? So we were right at it, like 0.1% below, but from a technical standpoint, we hadn't actually reached it. So I think that the history shows that we have had a very slow recovery over the last recession, and I think we could do that this time as well. This is just a little bit of a historical perspective. I just mentioned to you how that we're basically not back to pre-recession level in 2019, and you can see that we're not back to 2008, basically flat for the past several years. It's really the past couple years that we've started to see growth in excess of 1%, which is good for us, but nevertheless, it shows you how that we have struggled in recovery. Looking forward, is still, as I said, probably again, earliest that we would be back to pre-recession level would be 2023. So this is just annual growth rates for the past several years, give you some sense of perspective. And so again, for 2020, that's a 7.6% decline. For 2021, if we realize that, I didn't write the number down, I don't remember that number, but it would be the best thing that we've seen for since 2008, I believe. So. And part of the reason why the growth rates are so high is because you're growing from a low base. If you've got $20 in your pocket and somebody hands you $10, you've had a 50% gain. If you got $50 in your pocket, somebody gives you the same amount, well, you've got a much lower gain, 20% gain. So we're growing from a low base, so the growth rates are a little bit exaggerated. In terms of jobs, steep decline in jobs, just like at the national level. The preliminary April numbers, and these are preliminary, shows 117,000 job decline for the month. I would not be surprised to see them revise that downward. We lost, I think it was 78,000 jobs in the Great Recession. It took about 2 years for us to do that. We've exceeded that in 1 month. Okay, so again, you see the rapid decline. As I said before, I do think we're going to see some jobs pick back up as the recovery begins, but it's still going to take some time for all that to be large enough to see the overall growth in jobs. This is weekly claims, unemployment claims. There's 2 series for unemployment claims, initial claims and continued claims, and they both have value to us in terms of looking at the economy. The initial claims is someone walking in and says, I just lost my job and I'd like to get unemployment benefits. They may or may not qualify for the benefits, but they've asked for benefits and so they get counted. Continued claims is people who are actually receiving benefits. So they're both useful for us. The initial claims kind of gives us an early warning of what's happening. The type of increase we have seen in this episode is, again, we've never seen anything like that. The strongest weekly initial claims back in the Great Recession was 9,420. And so, we're over 45,000 is the high for this time. The strongest increase in continued claims was 50,000 back in the Great Recession, and we're now over 200,000. So again, just unprecedented increase in unemployment claims. We are seeing initial claims begin to fall. That's good. I think it probably will continue to fall. The continued claims will be a little bit of a lag on that, but they will eventually come back down as well. Unemployment rate, we think, like the nation, we reached somewhere around 20% before this is over with. Great Recession, we never went over 11%. So again, we think that it's going to take some time for that to come back down. So what does this do for revenues? All right, well, these are my estimates. They're just me looking at the economy. They're not the consensus estimate. They are preliminary. I would like to look at the May numbers before I give a hard number. It's basically me looking at what's happening in the economy and what we project happening in the economy, and if that continues and if our projections are true, what does that do to revenues? I know that we have some revenue data in, but for me it's not very useful for modeling purposes. There's so much that I don't know. I don't know what April sales tax was like. The April report for revenues reflects March sales. So I haven't seen the May report yet, so I don't know what sales taxes have done. As was already been mentioned, we've had a shift in the date for the filing for personal income tax and corporate income tax. That means that the April revenue report on those categories is likewise pretty much useless to me. It's not very helpful at all to me in terms of modeling. So this is my estimate based upon the economy, where we see things going. After we get May numbers, it would possibly change. For the FY 2020, my estimate is of $5,131.8 million, and that is $864 million below the November estimate. It's also $836 million below FY 2019. For FY 2021, my estimate is $5,598.4 million, or $367 million below the November estimate, or $369 million below FY 2019. Now, the numbers that I had gotten from DOR said that they were expecting that we would have a $436 million shift in revenue from FY 20 to FY 21 because of the change in the filing dates. I was not aware that that was an option, that you could count it as FY 20. I didn't know that you could do that. So their number was $436 million. So these estimates that I'm giving you reflect that $436 million estimate that I got from them. You take that out, obviously that changes substantially. What that does is it puts the brunt of the revenue hit in FY 2021. And for me, my estimate at this point in time is $803 million in 2021, around $428 million for 2020. So just a few final comments. The economic outlook is always difficult. It's more difficult now. This is certainly the worst that we have ever seen in terms of our history. It's not depression level, but it is a steep decline nonetheless, the steepest since World War II. There are some things that I think are mitigating the effect of this, and particularly here for Mississippi, and that is the transfer payments from the federal government. The direct payments to individuals for Mississippi we estimated about $2.2 billion, which is a substantial amount of money. The unemployment compensation, $600 a week for Mississippians, that's, for a lot of people, that's really good money. And so that's, we have those transfers in here. So it means that income levels are significantly supported throughout this. I do want to caution you about our forecast. Again, we always base it on assumptions. Usually we're more certain of our assumptions because usually we've got some more history and things are more normal. This is not normal at all. I don't know what's going to happen. I don't know whether there's going to be another stimulus bill. I don't know if there's going to be another round of virus in the fall. So I'm not, those types of things can have dramatic effect on the forecast. What I have done is to look at what they're saying at the national level, and based on history of the relationship between the nation and the state, and also looking at maybe some specific state level data, what we think is happening here in terms of buying behavior, we think we've come up with a reasonable estimate. Maybe I'm too pessimistic. Maybe I'm too optimistic. We'll have to maybe get more information. As new information comes in, we'll be able to maybe focus our outlook a little bit more clearly. So this is the best guess at this time. I think while the numbers may change a bit, I think our overall story is going to remain the same. That is, again, a very deep recession, relatively short recession, but a long recovery because of the depth of the recession. We think we take the biggest hit in the second quarter. Third quarter, we start to see growth, and the growth kind of gains momentum as we go into this next calendar year, and then sort of slows down a little bit. But nevertheless, even with that, it's in Mississippi, probably 2023 at the earliest before we recover our economy. So,
Thank you, Darren. Let me echo your statement. Because of this unprecedented event, it's extremely difficult. I think everybody recognizes that it's extremely difficult to even do some of your economic forecasting, and it's difficult for us here in the legislature to set a budget, not only to finish out 2020, but also 2021 and beyond. So hopefully everybody recognizes that. Let me ask you a few questions, and I got a couple for Herb, and then I'm going to open it up to committee members. I looked at your U.S. numbers, and I just did a rough guess, a rough calculation on the 4 quarters, taking the first big quarter that was down, the 36 some odd percent, about a 28% thereabout increase over the next 3 quarters, which roughly it ended up being a 6.8% to the negative on revenue or on annualized growth, which I think I looked at your recession number, which is about a 7.3% recession, and then your Mississippi numbers were much steeper, approximately a 40 some odd percent decline, and then with the next 3 quarters coming up, you ended up with about a 20% offset. So you're talking about, I mean, it was roughly a 20% decline. How do we, typically, I guess I would think Mississippi's, the recession's not going to be as hard, but the recovery's not going to be as great. You did mention the recovery's not going to be as great, but the hit on that second quarter of 2020 was tremendous in Mississippi compared to the nation. What models or what did you look at in determining that?
So historically, we have seen that very story play out. That is, in the last recession, the initial hit from Mississippi was not as much, but our recovery was much lower. And I think part of the reason for that is our dependency on government. Government checks go out no matter what, and so that supports us, at least initially. As a recession is dragged out and drug out, tax revenues do get affected. Tax revenues are not immediately affected, generally speaking, especially in the last recession. So, again, why it took us so long to recover, I think the whole nation, really the growth rates in this last recession were much lower than people were expecting. Despite tremendous spending at the federal level, we still didn't see very much growth coming from that. And I do think that it had to do with the nature of that recession. And I think it took us a long time. In Mississippi, we, as I mentioned before, we don't have the metro areas. That's where the majority of economic activity takes place in the country, and that's where the growth begins. And so we're on the tail end of that.
So this one would be a little bit different than other recessions, that our hit's going to be bigger instead of smaller by projections than the U.S. Hit for the second quarter.
Well, we were already at a low level, much lower level of growth. If you go back to the 2008 recession, we were at a much higher level. I think we're actually outperforming the nation in 2008. So We had a little bit of, I think, residual effect from rebuilding after Katrina, which sort of mitigated us a little bit early on. And we didn't have a housing sector, a housing bubble. We didn't have a financial sector. There are some differences in the recessions.
Okay, my final question is, on the short-term forecasting, you mentioned that typically you're going to do quarterly and not do monthly, but have y'all done a forecast for June of this year? Did I miss that, or did you?
So what I presented to you would be what would be coming out with the May numbers. So every month, IHS releases a national forecast, and I actually run my models every month because I just want to see how it's affecting us. And normally we just don't publish that. So I've already done the numbers for the month of May. June numbers will be probably in a few weeks before those will be released.
All right. And Herb, if I can ask you a question or two, if you don't mind, and then I'll let the members ask. Do you have a percentage, I'm not talking about dollar percentage, excuse me, but a percentage of numbers of tax filers that have already sent in their 2019?
82%.
So we got 18% left.
But they're the people with the money. I mean, that's the people who's,
yeah,
you know,
paying
taxes.
Right.
Everybody else has been getting refunds, mostly.
And that number, we're thinking maybe be at the 400 million range.
Well, no. The difference in the numbers Darren was talking about is the numbers I'm working off of are 8:30 this morning, 8 o'clock, 8:30 this morning. Staff had been doing a lot of deep dives over the weekend and everything. We think that range could be from about 335 to 365, somewhere in there. And I'm just like Darren. I got to see what happens in May and what's going on in the first part of June to narrow that number down closer.
All right, and then what do we think the impact of the, if y'all have had a chance to look at it, either one of you, the impact of the unemployment numbers? I mean, Darren, you got a big number up there on the unemployment. What's that going to have? Any way to tell how that's going to impact us on next year's tax returns?
Refer to the economist on that.
Benefits last.
Well, I think some will get it for 26 weeks and 39, 26 in Mississippi and up to 39 with the federal.
So I'm still trying to figure out how all that plays out, but my understanding from what I've talked to folks at DOR, we're not getting any income tax associated with that, but we will, and we'll get it next year. So the unemployment numbers could help us a little bit, at least in that it would offset some of the loss.
And did y'all factor that into the additional funds that came in through the unemployment and the increased benefits from the federal government? Did that factor into any of the spending habits, additional funds that some may have had to help offset our sales tax loss and other use tax losses maybe?
The money's coming to the state is factored in. As far as spending within the state, I don't have anything like that.
Okay. All right. Thank you, guys. Let me open it up to members' questions. Any members of the committee have a question? Senator Wiggins.
Thank you, guys, for that. Two questions. First one, I guess, is to both of y'all. If I understand what you're saying, Herb, we may have more, because of the move in the filing deadline, we may have more than expected, but we can apply that, or there's going to be a loss than what was originally projected, but we can apply it in FY20 or FY21. Is there, if I understand what you're saying, is there, economically, do you have a recommendation of what is best for the state?
That's y'all's decision to make. What it amounts to, it's a shell game. You're either going to take it out of your one-time money that you have on hand right now to balance your budget and end the fiscal year and count it next year, or you count it this year and use your one-time money next year. It's just, when do you want to use it?
The chairman has informed me we will discuss that, but I was kind of looking for a recommendation that is good for the economy, but we'll talk about that. And then, Darren, my question is, Do your models represent or reflect an attrition rate in the economy? And what I mean by that is we've heard about in the small business sector, you know, the thin margins and particularly restaurants, and some are not going to survive. And I think under the Great Recession, actually, you know, businesses got more efficient and the jobs, you know, became more technical, and so that there were jobs that went away. So my question is, do your models reflect an attrition that's in there, and do you see that us having to look at such things going forward as we recover, as was in the case of the Great Recession?
There's no variable in the model that says attrition or anything like that, but certainly it takes into account that there has been a tremendous economic loss, and the fallout from that would be involved in the model. But it's not something I can put my finger on and show it to you in the model. It's just based upon this is what's happening in terms of employment, this is what's happening to income, and when you have that kind of loss in employment and income, this is what happens to the overall economy. So included in that would be losses of businesses. Doesn't have any kind of assumption as far as, like you saw last time, where people began to, as you said, become much more capital intensive, and they invested in new technologies and things like that. There's nothing in the model like that. It could very well happen.
Senator Moran.
Aaron, question, and thank y'all so much for all the information this morning. What unemployment percentage rate you think we are at right now, or at the end of the April numbers, ballpark?
I'm sorry, I don't even remember the number. I don't know. That's reported at MDES. I can get it for you and send it to you, but I just don't know it off the top of my head.
You'd mentioned something like 200 million. That's nationwide. And the reason I ask that, restaurants are opening back up. A lot of businesses are opening back up. People are coming back to work. So those numbers from that initial hit, from the time to the time that we're opening back up now, those numbers are going to drop.
The initial claims is already declining. As I showed you the graph in Mississippi, we're already seeing a decline in initial claims. Continued claims is a little stickier, so it's still staying up there, but the initial claims are coming back down. And that's true, that you're going to see the unemployment, on that side of it improve. But then you've got the fundamentals of the economy, the fact that, as I mentioned about the oil industry, for example, less investment in that sector because of low oil prices. That begins to play a role. So while you see an initial increase in restaurant jobs, maybe manufacturing takes a hit, maybe the oil industry continues to take a hit. And that's why you continue to see those unemployment numbers be elevated.
There was a way to reach out to the business owners, just a survey or something. Here's what I'm concerned about. Your average weekly unemployment plus that extra $600, I think everybody in this room knows that there's going to be a certain percentage of folks that's more than they brought home in January and February.
Yes.
And they're not going to go back to work.
Right.
If they're making more money at home until that runs out.
Correct.
And what we need to know is if Jay's Tire Service, if they laid off 10 people and they're trying to hire them back and 3 came back, we need to know were those 7 offered their job back. And if so, at some point we've got to be able to curtail that unemployment if you've been offered your job back, or otherwise this thing will go on for a year.
I'm assuming that would be something that the federal level would handle, right? I mean,
I'm talking about on a state level here. In other words, our state people that and most folks want to work. I'm first to say that.
They do want to work, but they also respond to market forces. And so,
hey, if you can make more at home than you can working, there's a certain amount of people who's never going to go back to work.
People behave rationally. At least that's a good predictor of what they do.
Thank you, Senator. Any other questions of the committee members? Seeing none, hearing none, first of all, thank you, Herb, and thank you, Darren, for your presentation today. I'm sure we'll be talking a lot in the next couple of weeks, so everybody stay tuned. But I'll entertain a motion to rise and report. All in favor say aye. Aye. The ayes have it.